Greetings, comrades. When we start a VCE course, one of the first things you're going to learn about is the 4 accounting assumptions. You'll learn about 6 QCs, the accounting elements, theoretically. Rest assured, these will keep propping up throughout the course proper. So there'll be regular opportunity, regular exposure to scenarios where you need to apply your knowledge to aspects of the course. But good starting point to get used to the terminology. So importantly, with the 4 accounting assumptions, these guide the way that we record financial information. So in terms of the 4 that you need to know, we can make a little acronym if that helps you remember them. Very useful so that we don't confuse these with the 6 QCs, and that's a topic for another vid. So if you access the 2025 to 2029 VCE Accounting Study Design, you will find the definitions. So the purpose of this vid is just to unpack them. So what I've done here is I've underlined the guts of the going concern assumption. This is what you need to emphasize when you are responding to a scenario where the GC assumption applies. So emphasis on the fact that financial reports are prepared on the assumption that an existing entity will continue to operate in the future. So therefore, when we get to the end of a reporting period, regardless of the owner's position in terms of the owner might be planning to wind up the business, to liquidate it, to sell it, the GC assumption dictates that if we have any items that will not be converted to cash until the following reporting period, then we've got to treat them as assets. If they won't be converted to cash or fully consumed within one period, then we're going to classify them as non-current assets. Same with liabilities. If we get to the end of a reporting period and there's an obligation that needs to be settled in a following period, then that's going to be classified as a liability. So the GC assumption really is pinned down to the way we treat assets, liabilities, and we can go further in terms of the classification as current or non-current. Now, if you look at this slide, if you look at the study design, the accrual basis assumption is the meatiest in terms of the definition. This is the one that most frequently is examined. So therefore, expect to see this on multiple SACs, expect to potentially see this on the end of year exam. Emphasis needs to be on the fact that we recognize revenue when it's earned, we recognize expenses when they're incurred, so that we can calculate our profit on an accrual basis, revenue earned minus expenses incurred. So this comes into play when we look at when we need to do an inventory write-down, when our NRV is lower than cost. Once we realize this, there's an anticipated loss. So therefore, the accrual basis dictates that we make an adjustment, an inventory write-down. Same as when we do a stock take and we've identified an inventory loss. That's when the accrual basis dictates that we record the loss once it's been recognised based on that count. Same with depreciation adjustments, the allocation of the cost of the asset over 1 year of its useful life. So this is going to feature heavily when we do balance day adjustments in Unit 4, depreciation, when you get to the inventory topic with inventory write-down, etc. Now, students historically find it difficult to differentiate the accrual basis and the period assumptions. And just to confuse you, there'll often be questions where both are acceptable. So if you find yourself in a SAC looking at a question and it's asking for an assumption and you're not sure whether it's accrual basis or period, then possibly, potentially, most likely it's both. So therefore, pick one and then unpack it and then link your response to this scenario. I'll give you a subtle point of difference though. So when we're looking at the period assumption, be mindful that we need to divide the life of the business into these finite periods so that we can measure performance and compare that performance from month to month, if that's how long our reporting periods are, for quarters, for half years, or for a full year. So therefore, when we're determining our profit, we need to recognise the revenue that was earned for that period, whether it be a month, a quarter, half year, a year. And we need to deduct the expenses from that same period. So what's the difference between that and the accrual basis? Well, not much, but the point with the period is we're dividing the life of the business into these finite stretches, 3 months, 6 months, a year, one month. Accrual basis just says recognize the revenue or expenses when they're incurred. Okay, so yes, there's an overlap, but we can recognize an expense on the middle of a month, the middle of a year, the middle of a quarter, whereas this is just looking at start and end of periods. So this comes into play when we look at closing entries for revenue and expenses. So therefore, this is the only one you're going to be talking about for that aspect of the course. When we get to the end of the period, we close off our revenue and expense accounts to the P&L summary. Then we close off our P&L summary to the capital account. This will make more sense when we get there. Okay, the last assumption, entity, there's two components to this. So firstly, the assets and liabilities and activities of the business must be kept separate from that of the owner. That's the first one. But secondly, if the owner owns multiple businesses, multiple entities, then we need a separate set of records for each. We can't combine them because we want to have our users of the reports to be able to evaluate the performance, evaluate the financial position of each individual entity in its own right. So therefore, when the owner makes a contribution of an asset or a loan, which could be cash or equipment, a vehicle, that type of thing, then the entity assumption says that we must record that as a capital injection. Likewise, when the owner withdraws assets out of the business, usually cash or inventory, the entity assumption will dictate that we treat that as drawings. And so either way, whether it be capital or drawings, what we're doing is we're showing the change on the owner's residual claims of the assets so that, again, users of reports can evaluate the financial position and the claims of the assets, the liabilities being the external claims and the owner's equity being the internal claims.